Yeah, the deal with life insurance is there's a lot of salesmen involved. There's a lot of complexity involved, and a lot of it is just not worth your time. Life insurance does not need to be that complex. It's definitely important. You need life insurance, but you'll see. I'll show you a couple videos just to show you that I'm pretty whatever. Most people share the same opinion I do towards what kind of life insurance you need. And just to kind of summarize the whole night, term life insurance is generally the product that you're looking for. And the good thing about term is it is dead easy to explain. No salesman required. No commissions need to be paid. And it's just easy. There's other insurance products out there, and this is what makes it more complex, that are these kind of hybrid insurance and investment type things. So first off, does anybody have any life insurance, any like universal life or that kind of, do you do some of that stuff?
We do. We have 2 small policies for our daughter that are whole, because that's
Yeah.
what we do for minors. And then we have a blend.
Yeah.
And we have just term.
Yeah. The other thing I'll argue, and again, I'm not passing judgment on folks and stuff, but like some of these life insurance policies for young children, the parents need the life insurance. The kids, it's what you need, and life insurance is a pretty easy calculation. There's different ways to calculate it, but what you're trying to do is if you happen to depart, that the people around you, their lives are basically unchanged for the most part. So with
our daughter's policy, we watched. You can become uninsurable with health issues.
Oh, okay.
In youth,
Yeah.
like diabetes and stuff.
So that's a good reason.
So, and then you can get the policy for her was for that reason. If there's anything medically,
Yeah.
she's guaranteed insurance, and she can up it 4 times in her lifetime.
Yeah, and life insurance, it's the good thing about life insurance is it's cheap when you're young, and it gets progressively more expensive when you're old, but you don't care because hopefully you don't need insurance. We'll talk about what the function of insurance is, and it's fairly mechanical here. That all right, I can beat this thing again. I still never broken the code on what it's like. It just doesn't want to advance that first slide, and then it's all better from here on out. So anyway, define life insurance, determine life insurance needs, distinguish between 2 types of companies. I really don't care about that. They're talking about whether it's a mutual, if it's owned by the people who own the insurance company, or it's owned by a separate company. Who cares? You're getting paid at the end. I mean, you may derive some sort of dividend or something, but again, for term life insurance, that's not really a concept. Term life insurance is usually just owned by a commercial company. Important provisions of life insurance contracts, create a plan to buy life insurance, and annuities. Annuities are like life insurance, but they're a positive thing. I mean, unfortunately for life insurance, in order to collect, the only time you get the money is when you die. Well, annuities are just the opposite. You put up a certain amount of money, say like 20 grand, and you can start taking money right then, or you can have a deferred annuity where you take it, say, 10, 15 years from now. Then you can start taking out, let's say, $1,000 a year. And guess what? You put up 20 grand, you're taking out, you're going to be getting more than 1,000 a year, but let's say you're getting, 2,500 a year or something like that. Well, if you only live till, 52 or something, not such a good deal. But if you live to be 80, you're still getting at 2,500. So, 40 years worth of that 2,500 for the original 20,000 investment is a great deal. So annuities are a positive thing. It's a chance for you to kind of get one over on by living long. Define life insurance and describe its purpose. So what is life insurance? So, just what I said. It's a policy that pays a lump sum at the death of the policyholder. So sometimes while you're still alive, if you're like in a terminal condition and hey, you're gonna die, and maybe some quality of life things that can be made better with a little bit of a cash infusion now, or at least accelerated to get some end of life type things taken care of. Many policies will have that in there if you're in a literal terminal condition. So So what you want to do with, and this is what I'm talking about, why you need less insurance as you go through. So let's say, hopefully, I would advise most of you to at some point buy a home, unless you have some unusual condition where you're going to be traveling a whole bunch, you never want to buy a home. But, given the rate of the stock market right now, it's pretty volatile. I would feel better with real estate, and the best kind of real estate is the one you're actually living in. So anyway, let's say you buy a home when you're 25, 30, maybe 30, whatever. You should be, 30-year mortgage should be done when you're at 60. So that pay off the home mortgage or debts at the time of death, hopefully you're going to make it beyond 60, and you shouldn't have a mortgage. You're probably going to be stepping up, and you're probably going to be buying successive mortgages, but you're probably also going to have some other assets to where that mortgage will be covered. To leave as part of your estate, that's a personal decision, but it is nice, and you can do that. And it's also, if your, intention is to build this, lump sum of money and kind of live off the interest, and guess what, you're 40 and get killed somehow. All that planning for your family that was going to take care of them is now interrupted. If you have life insurance, then that lump sum would equate to part of that estate. To save money for retirement, education for children. Again, if say you're married and one of you happens to die, well, obviously it's going to be a little tougher road for that second person. In reality, they'll probably get remarried. But anyway, it would be nice to have a transition. Sorry, I'm not saying like day off, but come on. Anyway,
the funeral, but.
Yeah, but the education for the children, certainly. The kids are, if your intention is to help them out through college, again. But if you're in your 60s and you still got kids in college, good on you. Maybe you got remarried later or whatever. But most of the time, those expenses, the kids are probably getting older by that point. And medical expenses and funeral costs. Yeah, sometimes, just the bare necessities would be not, leaving people with death. I mean, you want to be at your funeral or your wake or what have you. You want to have people concentrating on what a great person you are and not what a deadbeat you were for leaving with no insurance. So there are people, that what do they call these guys? The name escapes you right now, but they do actuary guys who do mortality tables, and they can pretty much look at you and figure out pretty much, with some certainty. They can tell your lifestyle and and there are lifestyle things. Like Russian males don't live too awful long because there's a lot of alcohol and a lot of other things. A lot of Russian females tend to live a lot longer. But anyway, so they know these things. So, and they'll look at your lifestyle. Your women do tend to live a little bit longer. People in general are getting a little bit older. Some of this stuff gets a little scary too, especially when life insurance companies can get in some of these privacy issues and perhaps look at your DNA and your susceptibility to different. But anyway, we aren't quite there yet. But if you've got a history of heart problems in your family, cancer, it's going to fit into that equation. And if you don't have that, well, then you may want to be more upfront with it, because you can get these kind of guys who are, you see these car places where, no credit check required. Well, if you've got great credit, that's probably not the place you want to go, because if they're financing anybody, now you're lumped in with some deadbeat folks. If you have excellent health, you may want to go to a life insurance company that's going to require a physical, want to draw blood, want to do all that kind of stuff, and then that company is going to have pretty low risk people and should be able to get pretty good rates. But anyway, there's some ethical questions involved in that. How long will you live? Yep. Based on your life expectancy, payouts for the persons who died. So you can get enormous amounts of insurance, like $1 million or whatever, for, I don't know, probably $20, $40 a month when you're young. But as you get older, it's going to go up. But the good news is, like I say, you shouldn't need $1 million when you're in your 60s. And really, what are you going to do with it? I mean, that's the other case. You don't want people like they won the lottery or perhaps pushing you. Anyway, it's a long story, but woman wanted to marry me. I was worth more to her dead than alive, so I was very concerned about that. Anyway, yeah, she had a bunch of kids, and she was looking at, the medical, the retirement, it all continues. This will work out. I'm like, ooh, I don't have much value in the situation. So anyway, do I need life insurance? So if you're just you yourself, unmarried, nobody relying on you, it's not irresponsible not to have insurance, there is the thing that you're talking about, maybe to get insurance before you get some uninsurable condition, but anyway, it's typically, life insurance is for the people around you. And do you have a partner that works? Whatever, it is going to, change people around you. If you're the sole breadwinner, if you're the only person working, and you got little kids at home, somebody taken home, I mean, it's going to definitely alter that life dramatically. Whereas somebody's probably going to go back to work, or you're going to have daycare expenses, or whatever. So your goal here is with life insurance to minimize the disruption. So, how much money do you want to leave to your dependents should you die? Well, I mean, it shouldn't just be, I want to give $1 million. There should be a calculation to figure this out. So, what was your plan? I mean, you do sort of need to have a plan. Well, our plan with our savings is to have $1 million by the time we retire, and that way, with a reasonable interest rate, we can, draw, say, $70,000 a year on that, 7% interest. That's not bad. So we need something that's going to generate that same sort of income, one lump sum that's going to give us that amount. And it doesn't need to be $1 million when you're 20, because that $1 million that you were going to accumulate, that was going to be based upon interest and the rest of it. So you can get there. But anyway, you do basically a calculation. And how much will you be able to pay for your insurance program? With term stuff, it's pretty reasonable. Now, with the more complex plans, it can be kind of pricey, because they're kind of a combination investment and insurance product. And then also, because of the nature of them, they're not sold just typically online. There's normally a salesman, an advisor involved, and he's working on commission as well. So, but anyway, for term life insurance, believe me, you can pretty much afford to get what you need for a reasonable cost. Some of these methods, I'm just putting them out there because they're listed here in the book, but this one, you will need 70% of your salary for 7 years while your family adjusts. So I guess that's that remarriage option or whatever. 70%. So let's say you're making, just for ease, $100,000. So 70,000 for 7 years. So $500,000. $490,000. Dual incomes. In this case, both people are working and you don't have any kids. So half the debts plus the funeral expenses. I mean, that one's pretty easy because there's not a whole lot of insurance required in that sort of situation. And so that would be, certainly, well, in most cases, maybe under $100,000. Non-working spouse. So this is definitely going to alter these folks' lives. So multiply the number of years until the youngest child reaches 18 by 10,000. So let's say you got a 5-year-old, so that's what, 13 to 130,000. I don't think that's enough. And how many kids do I have? I mean, I got 6 kids. It's still 130,000. It's too simplified. I would rather go through and say, this is how much I need for the kids for college. This is how much I need to pay off the house. This is what it's going to take to, get us to where we need to be. And you're going to come up with some number, 800,000 or something like that. I'll show you after a while. We'll look on one of the sites. But, somebody who's in good health, non-smoker, and they will maybe do a blood test or something, so you probably can't lie about that one. But anyway, it's not very expensive. Family need method, more thorough than the first 3 because it considers employer providing insurance, Social Security benefits, income, and assets. So there was a thing I was just reading in the paper today about 1/3 of adults have no savings at all for retirement. So things are fixing to get pretty ugly economically here. And if you have any savings at all, the expectation of being able to get any of your Social Security money back is probably pretty remote. So, but employer provided insurance, I mean, that is life insurance. If it's life insurance in there, I'd certainly consider that. But I would consider that on any of these methods. And a lot of times, because employer provided insurance, you're already in a pool, and it's already pretty inexpensive. And usually, it's not. I've never had an employer provided insurance plan that had a physical associated with it. I've taken out individual plans, and I don't know if I told you guys the story, but there was this guy, who's kind of a guy O'Grady. He got shot down by that SA-6 in Yugoslavia years ago. Anyway, we got called in, and I was flying Weasels at the time, and it was like, it was a shooting war. So I'm like, ooh. I had two kids, or no, one kid at the time, and so I went through like a couple different policies, and I ended up with like $1 million in insurance just prior to the war. And it's so funny, they're asking me things about, do you scuba dive, do you smoke, do you do this? No. Not one of the questions was, are you going to a war next week? Do you fly fighters? Nothing like that. So anyway, I got all this insurance, and one of them, there was about 3 policies. And the lady, the phlebotomist lady, comes over and actually shows up at the house and like draws my blood. It's kind of creepy. But they want to be, make sure that they've got a good risk. And also, I don't know what they check for on that, but I guess cholesterol. I don't know how they can assess with like the smoking and things like that, but I'm sure they've got ways. So those are the kind of the needs method, but yeah, I would go through kind of a more involved family need thing, because I could almost do this in my head. Let's say you got a $400,000 house. Let's say you're fairly new to it, so you owe $400,000 there. You got a couple kids. If your intention is to put them through college, say $100,000 each, something like that. Money that you would have saved for retirement had you been working, another $300,000-$400,000, and something like that. You'd come up with an amount, and believe me, it's going to be $800,000 to $1 million, something like that. And when you're young, do it. It's not that bad. And there's it's just kind of the right thing, and it shows that you're responsible and all that. But again, it depends on what your situation is. If you're single and no kids, then you don't even need to worry about it. So this is what I was talking about by different types of life insurance companies, whether they're owned, stock life insurance company owned by shareholders or self-participating. But I really don't care what the business formation is. It's not that big a deal to me. But you can sometimes realize what it is by the title, like Mutual of Omaha, mutual type thing. That's where it's owned by the people who have the policy. So yeah, Mutual Life owned by. But you'll just see them in the names. Not a big deal. And they do pay a dividend sometimes, but whatever. You're going to go basically with the best overall rate. At whatever the policy is, and the dividend would be subtracted from the amount you're going to pay. And then, so that's the 2 types: the stock-owned ones, and then the mutual ones. Okay, now this is term life. Is not a any kind of company can own this or can sell this, but this is dead easy. Protection for a specific period of time. If you stop paying, coverage stops. Renewability, you can renew the policy without having a physical at the end of the term. So you don't want to let it lapse, is basically what they're saying. If you let it lapse, then, game on. You may have they may change the terms on you. And these things, it may be level term where the payments are going to be the same throughout the course of the policy, but the amount you get is going to decline. Or it may be a situation where you're going to get $1 million at the end of the policy, but your payments are going to increase as you get older. There's different ways of structuring it, different ways of marketing, but the good thing about this stuff is it's pretty transparent, pretty easy to understand, and it's sold on the internet. I mean, not, you don't just go to Amazon or something, but there's plenty of reputable life insurance companies that you can evaluate and decide what you need. And then there's also outside companies, AM Best and other insurance kind of rating companies that will, you can be assured that you're going with a reputable company. Because again, your policy's offered by the company, so you don't hear of companies going out of business very often. But you want to make sure you're with one that's there's legal requirements to the rest of it, but you want to make sure that you're with a reputable company. So this is what I was talking about: multi-level term, most popular. Where one of the things is going to change. Here's a decreasing term. Premium stays the same, but the coverage decreases. Conversion options, changing the term policy for whole life without a physical. So we got whole life, we've got universal life, we've got all these different ones that they're more like marketing terms. We'll talk about what they are, but for my money, I'm just not interested. I'm a term life guy. Return of premium on certain policies. Policy refunds every penny of the premiums if one outlives the defined term. So, at a certain point, they're using your money. So they're giving you your money back, but, time value of money and all that other stuff, it's not worth quite as much as it was when you gave it to them, say, 10, 15 years ago. But it's quite easy to calculate. And this is the kind of stuff where you go, okay, I need $1 million. And you look online, you find a policy that's going to give you $1 million worth of coverage, or maybe $1 million is a little steep for most people, but $500,000 worth, or whatever increment you need. Now, whole life, and they also call it straight life. This is kind of the start of these hybrid policies, right? And the problem is, and just categorically, is that there's investment companies. You got Vanguard, you got Fidelity, you got these guys who that's what they do, is investments. And then you got insurance companies that offer insurance, and they also offer investment product. And so the logic is that you're better off having your investments with an investment company, and your insurance just limited to the insurance aspects of it. Also, let's say you can get ahead by they'll come to you and they'll say, well, you should get a whole life policy because you're actually you need to start investing, which is correct. But what you should do is, let's say you're going to get a whole life policy and it's going to be $800 a month, or you're going to get a term life policy and it's going to be $40 a month. Well, all this investment part, the notion is that, okay, I get the term life for my $40, I'm saving basically $760 by not getting this term life thing. But what I'm going to do is I'm going to invest that other money. You know what I mean? I'm going to put that in a mutual fund type thing. I'm going to start buying real estate with that money. I'm going to start investing that money. It's not like, oh, I got a great deal on insurance, I'm just going to blow all the extra money. That you're going to end up worse off. But this is the logic that I'm using when I'm saying term life insurance. Is I'm saying use the term life insurance because it's cheaper, and it will, in terms of opportunity, it will free up that other money that's available to you to invest. So you're putting you're keeping your insurance and your investments separate. Let me, before I go too much further, let me show you a video just to show you that, there's other people kind of agree with what I'm saying. I'll show you, there's actually 3 videos here. USA is actually an insurance company that I have, and they're reputable and all, and they'll kind of make the term about, why you want some sort of universal life or some sort of hybrid investment insurance policy. But these other folks are pretty adamant in terms of why you want just term. So this is Sue Zorman. She's kind of...
video cue. Let's go to Catherine in Salt Lake City, Utah.
So what we need to do is, I need to hook up this other cable. Where is the microphone cable? Oh, there we go. So anyway, she's just a TV person, obviously she's more in entertainment, but her advice is pretty sound and pretty common. if you listen to guys like Dave Ramsey and all those other folks, they're dead set against anything but term life insurance. So.
Video cue, let's go to Catherine in Salt Lake City, Utah.
Good evening, Susie. I'm married with 2 young children. Our financial advisor signed us up for variable life insurance on my husband. We pay over $600 a month with a death benefit of $750,000. We've had it for 6 years, and I've never felt comfortable about it, and I'm wondering what we should do.
What you should do, first of all, is get yourself a new financial advisor. That's number one. Miss Orman here has a top 10 hate list of investments that she hates. And she hates them because they literally do absolutely nothing for you, and they do everything, in my opinion, for the financial salesperson that sold them to you. And variable life, universal life, whole life insurance, that's probably on the top of Miss Orman here's top hate list. So, the only type of life insurance that you should have, in my opinion, is term insurance. Insurance that's good for a specific period, a term, usually until your youngest child is 23 years of age. $650 a month for $750,000 of insurance. Do you know, with a 20-year level term policy, let's say you were in your 30s, you could do that for $50 a month. Not $650 a month, and then you can take that $600 and do what with it? Put it into a retirement account. Insurance was never meant to be a permanent need. It was only meant to be there during your younger years in case something happened before your assets built up. Here's what you need to do. I want you to get yourself a 20-year term insurance policy in place. Then cancel your other insurance. Never, ever, ever cancel insurance until the new one is in place. And like I said, get another financial advisor. All right.
Anyway, kind of over the top, but what she says is of value. And that business, though, of, this isn't 600 extra bucks to go, buy snow machines and do other stuff with. You should have, your whatever you're going to determine, 10, 15% of your income that you're going to put away towards retirement. And, if it's being done through an insurance product, you're not getting as much value out of that. So you still want to allocate whatever you're going to allocate, and you're going to take care of your insurance needs through, a $20 or $40 payment once a month. This guy's got a bit of a different take. We'll talk about it after he finishes.
Tim out with 90-second finance. Today I'm going to answer a question that I get all the time. That is, should I be buying term life insurance or permanent life insurance? And I should say that there are appropriate uses for both of these, but I will say I do believe that permanent life insurance is oversold. Here's why. Term life insurance is just a pure insurance calculation with actuaries at the insurance company that you are going to live or die within a period of time that's normally ranging between 5 and 30 years. Permanent life insurance also has that pure insurance at its core, and then it also has a savings vehicle. But this savings vehicle comes at a cost. And the cost is so substantial that it is important that you have met other financial planning needs before you spend a dime on permanent life insurance. That is, you should have adequate emergency reserves between 3 and 12 months of your living expenses. You should have maxed out 401ks. That's $17,500 in 2013 for each spouse. Maxed out your Roth IRAs. That's another $5,000 for each person. And you should also have adequately funded your education. Now, here's one of the things I hear insurance agents say that want to sell permanent life insurance. They say to people, look, term life insurance only pays out in 2% of cases. You know what I say to that? That's great news, because that means you haven't died. This is Tim Howe with 90-second fund.
So the point why I wanted to bring this up, too, is for an insurance product, right? Let's say, you're like this lady, where you're spending $600 a month on your life insurance that also is part of an investment. But that's $600 that's not getting any special treatment whatsoever. That emergency fund, obviously, you need to do that. And if you're funding this life insurance policy and you have no emergency fund, yeah, that's not smart. the 401k, that's tax deferred. That's smart to do tax wise. And if it is, it goes up every year. We say 17.5, and it goes to 20, and then all of a sudden, if you're age 50 or older, you can do 25,000. So that's a pretty big chunk. That's getting privileged sort of tax treatment. That is probably a better investment than putting in the insurance. The Roth, you can start doing that. Roth is again, you're using taxed money, but it's not going to be taxed in retirement. So something you want to, these are programs that you want to take advantage of. And then the education type stuff, 529s and other things, if you're, one of your goals here in your investing is to be saving for your kids' college, a 529 plan, a TUGMA, a Uniform Gift to Minors Act type investment, those types of things are, more efficient vehicles to generate that money. And so the insurance type thing, where they call it, and I know it's confusing, whole life, universal life, all those different terms, we'll talk about a little bit of variation of them, but they're largely kind of the same, are not going to have that advantage status. So one last one. Well, this is kind of the other side of the story, and they're going to do their best to try and sell this.
Hello and welcome to Ask USAA. My name is Scott Hollowell. We have a question from Cesar in Texas. He's looking into life insurance and he wants to know, is universal life insurance worth it? He says it seems as though he could just buy term insurance and then save the cash value money himself. Well, Cesar, to your question of whether or not universal life insurance is worth it, in my opinion, the answer is yes. A universal life insurance policy can definitely be worth it in the right situations and if it's used for the right reasons. So, what are those situations? Well, if you want to have insurance in place for your whole life, or if you want the flexibility for that, then a universal life insurance policy might be a good strategy for you. On the other hand, if you feel that your insurance need is temporary and may end at some point, then a term policy might be better for you. The reality is, from a planning perspective, I think it's ideal if people can have both. That way, you get the coverage you need today at a cost that's more affordable. You'll be able to have insurance in place when you're much older to cover your final expenses like funeral costs and the like. And finally, you get much more flexibility down the road depending on what your life situation turns out to be. Let's take a look at an example I've created to help illustrate why this flexibility might be important. So what I've got here is a case of a 30-year-old father with 2 small children. Let's say that he's concerned about making sure that his kids are going to have enough money to go through college should he pass away beforehand. So, to cover this need, let's assume that he looks at the different types of coverage that are out there, and to keep his costs low, he decides to take out a $250,000 20-year term policy. Now, let's assume that he lives, that he doesn't pass away. The kids are grown up, they get through college, and now the father is sitting there with his $250,000 term policy and some questions. He wants to know, what should I do with it? Should I keep it or should I cancel it? Of course, he could just cancel the policy since the goal for which he took it out is now behind him. But let's assume that for whatever reason, he wants to keep the policy in place. Well, the problem here now is that because he's 20 years older and that initial premium was only locked up for 20 years, the premium to keep the policy in place going forward is going to be a lot more expensive. So expensive, in fact, that many people would say, I'm not going to keep the insurance. I'll just let it go because I can't afford to pay it anymore. But let's go back to our original setup. What if, instead of purchasing term insurance, our father had purchased universal life insurance instead? Let's see how that would have looked. Well, he would have had higher premium payments up front, but the sticker shock that we were talking about here with the increased premiums typically wouldn't have taken place, since these policies are generally designed to keep the premiums relatively level over the life of the contract. To your point, though, Cesar, couldn't our father here have just purchased term insurance, saved up the difference between the premiums of the term and universal life policies on his own, and used that pool of funds to pay for the insurance now? Well, the answer is yes, he could have done that. But even if he did, the sticker shock that I talked about would still be there because the insurance is still going to be a lot more expensive. And that, of course, assumes that the money he set aside stays set aside. Unfortunately, what I've seen happen more often when people try to do this is they typically don't end up saving the money. Instead, they end up using it for something else. And unfortunately, when they get to the point of wanting to keep the insurance in place, there's no money available to pay for it. So, to come full circle, is universal life insurance worth it? Again, I say yes, if it's used in the right situations and for the right reasons. Having some level of permanent insurance in place can really be a good idea for a lot of people. Thanks so much for your question, Cesar. I hope this explanation of how to approach this has been helpful, and I wish you and your family all the best.
So what do you think? Change anybody's mind? You know, a couple of things. I think he's kind of insulted Caesar there that he's not going to be able to save. You're not going to save. Wait a minute, you know. If you don't have that sort of discipline, you don't have the discipline. But it does, what he also doesn't really make the argument for is why this guy needs that $250,000 insurance later in life. You know, it's kind of a nice to have maybe, but anyway, if it's just not for me. I would prefer to have that 200. I certainly want that $250,000, but I could have had that had I invested that money wisely and you know. Anyway, different ways to do it, but I'm kind of unchanged in terms of still just wanting to go with term. Let me get back to the slides. So I'll kill that audio here in a second. Okay, so different kinds here. You know, whole life, pay a premium as long as you live, depends on your age. Death benefits accumulates a cash value, so there's actually an investment to it. You can borrow against it, but look carefully at the rate of return, and that's what they're saying. You may not like it. You know, it may be down in the not quite what real estate or mutual funds or other things are doing. So there's also some caveats with it. You know, sometimes you only have to pay for a certain time, and then it becomes fully funded, and it's this permanent life insurance. You know, term life insurance, you cancel your insurance, your term life insurance, you're done. You know, there is no money, no residual value to it. It's just over at the end of that term, unless you reinstate it. Variable life, so minimum death benefit guaranteed, but death benefit can be greater than minimum depending on the earners of dollars invested. So what they're trying to do here is in a variable life, they're trying to make it more competitive. They're saying, we'll give you at least this amount, but it could be more based upon, you know, how the market does. So again, it's a marketing thing to make it more interesting and more attractive to people who are, you know, maybe not interested in the whole life. Adjustable life, change the policy, you know, more marketing things. Universal life gives you more control, increased cash value. But again, it's, you know, same sort of product. It's a permanent life insurance, but with just different features kind of added in. But again, you know, and then group life insurance. Now, group life insurance is not a, you know, it's a form of term insurance, and often provided by an employer. No physical is required because you're already in sort of a pool anyway. And you will generally, when you're looking at your life insurance needs, you'll say, okay, my employer is providing me whatever, say $100,000 or something worth of coverage. Okay, so I've decided from my calculation I need $500,000, so I don't need, you know, $500,000 for my own insurance. I'll take into account what the employer has given me, and that'll be part of my formula. So, to tell you the truth, I've got, you know, some term life insurance that I need to pretty much cancel here pretty quick. But again, it's still not very expensive. I haven't, I guess, hit that age where it goes astronomical. I think I've got a $250,000 policy. It's like $46 or something. It's just not that big a deal. I actually have a term life insurance policy through USA as well. I don't know why I've got the multiple insurance. It's all holdovers from that one Biden spree I went on just prior to the war. So do you understand life insurance a little bit? I mean, the big thing is to do a calculation. And I don't recommend those quick, easy methods. I recommend just looking at what you've got. You know, okay, we just bought a house. We got this outstanding mortgage. I want to have something for the children. I want to have some sort of lump sum to make up for that money that I would have saved. You know, along the way. And again, if I want $1 million when I retire, maybe an extra $250,000 now that's going to grow into $1 million by the, say, 20, 40 years it would have been until I retired, and you'd be perfectly fine. And then every 5, 10 years, you kind of review it. And maybe you say, I need more, and you go buy a second policy perhaps. Because once you buy a term policy, you generally don't monkey with it. And that's how I ended up with multiple policies, is because I need more. And so rather than mess with that one, it probably would have been cheaper to start out with one big policy, but that's just not the way I did it. I'm not saying the way I did it was right, but anyway, it's something that it's a dynamic calculation, is what I'm saying. And as your nest egg builds up, as your house gets paid down, as your children grow up, your insurance gets to the point where you're basically self-insured. I got enough money to get myself buried, all my debts are clear, I'm good. Other things, endowment life insurance. So, just a different way of doing it. Covers from the beginning of the contract to maturity, guarantees payment of a specified sum insured. So again, it's a form of permanent life insurance. It's going to pay at some point. Credit life insurance, yeah, they act like, you got this great car loan with it, and part of it, we're giving you a life insurance policy. It's not really, it does help you out, but what it helps them out is they don't want to be going to the grieving widow or widower trying to get money out of them to pay for this car, especially when there may be medical bills. They're just done. Their loan is going to be paid off. If you have credit life insurance, your credit card balance on that thing is going to be paid off upon your death. And the insurance company, or the credit card company can just walk away with the car or the mortgage. It'll usually be part of the policy, and usually not an optional thing either. Naming a beneficiary, contingent beneficiaries. So easily done. You can make this fairly cosmic. There's percentages and there's specified people in there. Grace period for late payments. You don't want to get canceled. And you want to make sure, I always pay my bills on time. But what if you move? What if the bills get sorted out? And I have had, insurance companies can't just cancel you. They have to be pretty diligent in terms of trying to get a hold of you. And you just don't let it lapse over something like 90 days or something. It's pretty typical, and you're good. Keep accrued benefits if you drop the policy. Incontestable clause. After a couple of years, some of those things that you may have fibbed on might go away. But if you, whatever, they will ask you things about, do you scuba dive? Do you, sport diving? And sure enough, turns out you've been doing that. Well, you may have problems in the first 2 years. After 2 years, you're generally good. And the term people, I've never had, other than that blood test, nobody's ever come and checked on me. Suicide clause during the first 2 years. Again, that's probably for most people's benefit. They don't want to put people in a desperate situation where they need $1 million and the only way to do it is to kill themselves. So that's probably a societal good. Automatic premium loans. Misstatement of age. Yeah, you lie about your age. That's because these actuarial tables are based upon your age primarily. If there is a cash value, but term life insurance does not have a cash value, so I don't care. Waiver of premium for disability benefits. Sometimes there is a clause like that in a policy where if you're disabled and obviously you're not able to work, you may still be able to keep your insurance if that's part of the. It's kind of a low probability. It doesn't cost the insurance company much to offer that to you because very few people are going to get disabled like that. Accidental death benefit, double indemnity. And you'll see this, accidental death and dismemberment is usually what they say too. So if you lose a limb or something, depending on the way you die, it's kind of gruesome. But guaranteed insurability option. But again, one of the reasons why I used to be with USAA is now kind of a big general company, but at the time, a long time ago, all they insured was officers. And so it was like everybody needed to be a college graduate to be an officer, basically. If you get, if you got a drinking problem or whatever, they'll throw you out. So anyway, you ended up with this pretty low risk category, so they could offer insurance for fairly inexpensive. And so, you know, you don't necessarily want to run in and take the insurance that's going to, you know, not require a physical and not require any of this stuff if you're in good shape. If you're in bad shape, then yeah, maybe you want to go for one of those. But again, it's like buying a car with a, you know, no credit check. Well, that's probably going to be a higher interest rate because they got to cover those people that have got lousy credit. Cost of living protection, obviously insurance or inflation is going to go up. Accelerated benefits for terminally ill, you know, we talked about that. Second to die option, survivorship, insures 2 lives. But again, I'm more into the individual part, individual policy. I've never had a second one. So depending on what you're buying, you know, if you're buying a whole life, universal life, any type of permanent life insurance, yeah, it's going to be done through some sort of agency with a salesman involved. It can't just be sold because there's people have to have, you know, they have to be licensed insurance agents and all that. In a term life policy, you probably will, you know, actually have one of those people sign off on the policy, but it's going to be minimal involvement. There's not going to necessarily be commissions involved. So if you want term life insurance, you can, you know, I've used things like SelectQuote and things like that, and we'll go and compare a wide variety of insurances and do it that way. I'm not saying I recommend them, but that's one option. But you would want to certainly look at, you know, something like AM Best or something like that. But names that you know, there's Allstate, there's whatever, Mutual of Omaha, there's State Farm. I mean, there's substantial companies out there that are kind of, you know, family names or you know, familiar names. And but anyway, you would look at AM Best or Standard & Poor's, somebody like that to see what's going on. Friends and colleagues, you know, maybe parents or something, but friends and colleagues. Sometimes people, you know, kind of get hustled and they, oh yeah, it's the greatest deal, and you know how it is. Some people are more susceptible than others, but I'm more want to look at the technical details. And again, Standard & Poor's rates them as well. So AM Best pretty much concentrates on insurance companies. Standard & Poor's is more of a general investment. Choosing your insurance agent, you know, again, if you are somebody, maybe you're going to be living, you know, here in Alaska forever and you want to have an insurance agent. I don't have some personal guy. I mean, never have. I tried to do that with my business insurance and it was just kind of flaky. I just didn't find anybody, and so I went back to just getting it online. So I don't have a person I work with. I don't know. Do you? Does anybody have somebody? It might be helpful. Yeah, somebody you call. But yeah, you want somebody who's going to have, you know, be authorized to sell the products, especially if you're going to get one of the more complex products. Yeah, again, this is like buying a car. If they're pushy about something, that's probably not what they want, you know. And you want somebody who's going to ask kind of the right questions, you know. Ask, you know, about your plans in life and all that. I mean, that's the only way you can really size up what you need in terms of insurance if you don't do the calculation yourself. And yeah, if you feel pressured, that shouldn't be part of the situation. And again, this, you know, should be an evolving process because again, your insurance requirements are going to be dynamic. But if you do, you know, find one good company and try to get all your policies with them, assuming it's a good company, it will probably simplify your life, you know, in terms of better rates and just consolidating type things. Compares policy cost. So again, that selectivity is a good thing, you know, if you're a low risk person. The cost of doing business, you know, I get deluged by certain companies sending me all this direct mail, and anyway, they're pretty high marketing costs for their products. Return on their investments. What they do, insurance companies, you know, they get those premiums that you're giving them and they invest them. So you're kind of depending upon how smart they are with their money as well. Mortality rate amongst policyholders. So again, if you can get in a more selective group, you know, if they've got a fairly elite group of clients, then that's going to make them more profitable and their policies a little bit cheaper. Policy features from other firms. So again, you have to compare features, but some of those comparisons, you're probably best off going to a more objective site like an AM Best or something like that, rather than the individual company sites, so you can compare across different policies. And then use interest-adjusted rates to compare policies. But anyway, quotesmith.com. I haven't used those. I've used some of the other ones. Again, Quotesmith just offers quotes. Some of the things like SelectQuote, they actually sell the policies as well. But there's a multitude of sources out there on the internet. But you want, if you're going to use one of these .com type sites, you want to make sure that they have all the products and not just the ones that they're, that they get a cut of that they're pushing individually. And then obtaining a policy, it's dead easy. You fill out the paperwork, provide the history, so a lot of questions. Can be a physical, generally not. I have had, actually I was going to work for there was a company that was Baker Tools, Hughes Tools, selling oil field stuff right out of college. And but they were more concerned about my back and things like that because there's a lot of heavy lifting. But that was part of the thing. The contract, read every word. I mean, it's probably going to kill you. Yeah, if you're that concerned about it, you might want to get a lawyer because it's going to be sometimes a little bit of knowledge you can get yourself in over your head. You do have a change clause. And again, this gets back to the salesman kind of pressure thing that people tend to overbuy. They get kind of hustled. And so there's kind of get out clauses. But I've never had any sort of buyer's remorse with term because we're not talking a significant amount of money. You definitely need to let your beneficiaries know, where the policies are. And this goes without, saying for a lot of things, and a lawyer have a photocopy. Most of us don't have, continuing relationships with lawyers. We're not, that high wealth sort of individuals. But definitely having those records. But you need your will. You need other things that are available, especially if you got multiple policies. Your mutual funds, your investments. You need to have access to all of those. Settlement options. Yeah, this is just sort of style features here. One big chunk, installment payments to the beneficiary for life, proceeds left with the company. Anyway, you can do it different ways. But if one of those is important to you, just keep in mind that there are options. But lump sum is all I've ever had. And, it's kind of like the people who win the lottery. Are they going to take it all in one big chunk, or are they going to get it spread over a number of years? Anyway, in this case, once you, as the person before you die, you choose how it's going to happen, and the beneficiary is normally stuck with whatever you chose. Switching policies. So, yeah, there are some, systems here. Typically, with the term stuff, it's pretty easy. You may add another policy, and then when you kind of age out of that need, carrying $1 million when you're 60 is hopefully you don't have $1 million in debt. So why are you carrying that policy? So you would just start canceling policies. The older you are, the higher the premium would be, or if your health degrades, it can get bad, and that's where they talk about are you still insurable? Can you get all the provisions you want? So anyway, it does make sense to not wait too awful long, but again, if you're a single guy, you may not need it. And then annuities. So we're going to kind of race through this part again because we're going a little bit long in this hour, but we're going to talk about the term project afterwards. Over spring break, there was a bunch of people trying to work on that, so I sent off some emails, but I realized we'll spend a little bit more time on it. We'll talk a little more about insurance. But there's not too much more here in the life insurance bit. So annuities, I kind of told you how they work. They're just the opposite of insurance. You put up a lump sum, and they start making payments to you, and those payments continue till you die. So It can be a very bad deal if you die quickly, but a very good deal if you live long. So it can be a great mechanism. So supplement the retirement income, shelter from taxes, annuities are tax deferred investment plans, and those who expect to live longer than average benefit the most. So, you take some sort of annuity, you do it when you're in your 40s or whatever, and you put forward a lump sum, and it's going to pay you, say, $1,000 a month for, and it can be a deferred annuity. It can start paying you $1,000 a month when you turn age 60. That's kind of nice to have, So it's a way to give yourself a little bit of a cushion there. And like I say, it's much more optimistic than insurance. It's like that guy said, the fact that the other ones only pay off in 2% of the cases, that's a good thing. You don't want to, you're not getting one over in an insurance company. If I get paid off, you're dying. So, anyway, let's take 10 minutes. We'll come back and we'll just concentrate on the project for the rest of the time. Any questions on insurance at all? Not so much?